$90,132 of income, $386 of income taxes. I love this job. I love this job. Has anyone else ever guided you like I have here? I'm sorry to be cocky. Has anyone ever done like I've done? No, no one has. Buy me a coffee, man. Buy me a coffee right there in the freaking show notes. You'll see the doobie-doo to buy me a coffee, because this makes me happy that people are getting it, and also makes me say, I'm doing good work here, man. Now, you might not like my conspiracy theories, all that. That's fine. I don't care. It's just weirdos. Josh, you have so much sense when it comes to finance, but everything else, you have no common sense. I know, right? The common sense just stops the minute non-financial stuff. The common sense just stops. It's kind of weird how you're so smart here, but everything else you're dumb. Okay. Anyway, so check this out. Here's my man. We'll call him Bob. Bob, $90,132 of income. His taxes going to be $386. 0.43% effective tax rate, amigos, on almost $100,000. He says, I thought I understood how to figure this out. After looking at this, I'm wondering what I missed. I haven't factored inflation. I know the numbers will be somewhat different when I reach 70, but I'm just looking at ballpark numbers. I've watched probably all of your old basement whiteboard tutorials. Loved them. They're coming back, maybe. They're coming back. And bought 3 of your books. We're putting off filing for Social Security until 70. I'm retired. Currently, I'm past my FRA, 67 this year, and my wife is 66. She should go ahead and file. She's at FRA. She should file for hers if she has any bit on her own record. But anyway, we'll keep talking. We're covering my expenses with my IRA. Pretty easy to do with no house or car payments, plus have solar that pays my highest summer bills, electricity in Phoenix. All right. So here's his income. This is with his delayed earnings credits. That's 70. Here's wife's, half his PIA, so you can quickly figure out his PIA is about $3,300 or so. So his wife will get half of his PIA with 1676. 1 second, 1676 divided by 0.5, 3350. So his PIA is 3350. His wife will get half of that 3350, but he's taking his benefit, his own retirement benefit at 70. So his PIA will grow from 3350 to 4335. So Social Security would be 72,000. He's got a small pension. He's going to take IRA distributions of 12,000. So that's his income right there. All right, that's the total income. It's not his taxable income. This is the total spending power before taxes. So we got to figure out our provisional income to figure out how much of our 72,132 of Social Security is subject to taxation. Remember, what we're doing with provisional income is the first step in the tax two-step. How much of your Social Security is subject to taxation? Don't just default to say 85% of your Social Security is subject to taxation. That's a huge mistake. So how we figure that out is with this provisional income. We take half of our Social Security benefit, $72,136, divide by 2 equals that, plus all of our other income. He's got $12,000 IRA distribution and $6,000 coming from his pension. So his provisional income is $54,000. Again, his total income is $90,000. His provisional income is $54,000. Come down here, and we see the first $32,000 of his provisional income is not subject to any taxation. The next $12,000, 50% of that is, so we know that between 32 and 44, $6,000 of that is subject to taxation. Anything above 44,000, 85% of that is subject to taxation. So again, the first bucket here, or it's not really a bend point, I guess bracket, that's what I'm looking for, whatever. It's 32,000, so we got 54,000, 32,000 right here. That's his total provisional income. 32,000 is the first bucket, if you will, of how much of his Social Security is subject to taxation. That's zero, right? The next $12,000, 50% of that is subject to taxation, which is $6,000. The next amount, 85% of that is subject to taxation, which is $8,500. So of his $72,000 of Social Security income, only $14,500 is actually subject to taxation. All right, so we scroll down here. We take his taxable Social Security, $14,556, plus his pension, plus his IRA distributions. His total adjusted gross income is $32,000, but he has a standard deduction of $28,700. His taxable income is $3,800. You don't believe me? We're going to show you in Right Capital. All right, so here, I'm going to show you right quick. We got Susie and Bob sample, all right? I'm just going to go over to profile. I wish people understand this. So we got, let's say Bob's got $500,000 in an IRA, 401k, doesn't matter. All right, we're going to go to income. We have Bob's Social Security is $3,300. This is PIA, but he's going to wait till 70 to take it. Susie has her own benefit of where was her benefit? Right here, like $900 a month on her own record, which he should file. And this guy, whatever this guy's name was, Barry, I don't know. He should file. He should have his wife file if she has any benefit whatsoever. So in this case, Susie's got a small benefit, and she's at FRA, so she files to get something on the board. And then once Bob files, Susie's benefit will increase with spousal benefits. All right. So Susie got $900 of Social Security, and again, that will increase to half of this right here once Bob files. All right, and that will be at 70. All right, Bob's got a pension like we just talked about, or Barry, doesn't matter, $6,000 a year. All right, so now we got goals. How much they need to live on? Well, I got them living on $4,000 a month. That on top of, we still need health care. I got them living on about another $1,000 a month on health care, and then they still got property tax and homeowners insurance. So we got property tax and homeowners insurance, and another $400 a month or so. All right, so I hope that makes sense. So now we're going to go to retirement, and we're going to go to cash flows, and we're going to show you. It's pretty simple. So in 2023, they got $10,500 coming in. That's going to be from Susie's Social Security. Again, not a huge amount, but we'll take it, plus Bob's pension. $10,500 coming in. They need $75,000 to live on. Why? Because they got $4,000. Oh, that's a proposed plan. Let's go to current plan. Yeah, well, I'll even show the proposed plan too. They need $60,000. That's basically a little bit more than $5,000 a month to live on. Why? Because they got $4,000 a month of day-to-day living expenses, the housing costs, and the health care. $62,743. But they only got $10,500 coming in, so the rest is going to come from Bob's IRA, his retirement accounts. So here they got $10,500 plus $56,000 from the IRA, which will cover this $3,700 in taxes. Everybody with me on that so far? All right, so check this out. We're going to go to proposed plan too. It doesn't matter. I'm just trying to throw you a couple different numbers out there so you can see. Here we got $10,500 coming in. They need $74,000 to live, $75,000 to live on. They don't have enough coming in, so they need to take the rest in their portfolio. All right, so here we got our total outflows are $80,000, which includes $5,000 of taxes. Now I got them living here in Georgia, no state income tax there because they don't make enough money. All right, so they're paying $5,400 on $80,000 a year in income. Divided by 80, that's a 6.75% effective tax rate. Not too shabby. All right, but it's going to get better. Let's just go back. Let's stay here. So now, look at this. In year 60 right here, here's year 70 right here. Bob's first full year of Social Security. All right, here's his first full year of Social Security. You'll see that when Bob files, so Susie had her own retirement benefit of $11,000, but when Bob files, it increases. She still keeps her own benefit. It increases, though, because she now gets a spousal benefit. Notice, before Bob filed, no spousal benefit. Bob files and a spousal benefit kicks in. That's why, in that guy's case, he should have his wife file if she has any benefit because, $11,000, $11,000. So now Bob files. Susie still retains her benefit, but she gets an addition via what's called a spousal benefit. So now we got $70,000 of Social Security. Everybody with me on that so far? And we got $6,000 of a pension. So between Social Security and pension, that's $76,000. $76,000. They need basically $83,000 to live on. So they're going to pull $5,600 from Bob's IRA. And you can see what I'm talking about. We go to accounts. We go to withdrawals from accounts, and you can see right there the amount he's pulling from his IRA. All right. So again, they're living off $82,000. The bulk of that's covered from Social Security, but they need about $11,000 from his pension and IRA combined to make up the difference. So now we're going to go to the tax form, and we're going to show you the 2025, I think, right here. Yeah, so here's their, that's not good, 2026, I think, it's way full. There we go. So here's his Social Security, $70,000 of Social Security, plus their IRA distributions, plus the pension. All right. Of that $70,000 of Social Security, only $8,500 is subject to taxation dues. I cannot stress this enough. So $8,500 plus a pension plus the IRA distributions, their total income from a 1040 perspective is $20,000. Now, in reality, it's a lot more than that because we have $71,000 Social Security. But from 1040 perspective, their total income is $20,000. Standard deduction, $25,000. Their taxable income is zero, which means they have no taxes. I'm going to show you another video here. Annette had emailed me about some various counties that you don't pay property tax if your taxable income is less than $12,000. And we just showed you how to make your taxable income less than $12,000 just by maximizing Social Security, which means you don't pay any income tax. And in this case, where Annette was looking at moving to, you're not going to pay property tax either. How freaking awesome is that? People don't know this, though, because they don't pay attention. They're too fearful. Like, oh, my goodness. So now we're going to say when Bob has RMDs, let's go to RMDs right here. He's got $15,000 required distributions, plus his pension. That's $21,000 of income right out the gate, plus his Social Security. So we know he's going to have over $100,000 of income. But only $21,000 of his Social Security is subject to taxation. All right, so we take our basically 22 plus our other income. We got about $44,000 of total income. But he's got well over $100,000 of real income, but $44,000 he's showing. All right, take away the standard deductions. Our taxable income here is about $15,000. All right, so that would give us a problem if we're looking at maximizing property tax reductions because of our taxable income. So in this case, if he had over $15,000, he would be subject to some property tax in this county in Alabama. And there's other counties that do the same, which I'm going to look into more. But either way, $82,000, $88,000, that's $104,000 of income. He's paying he's paying tax right here, total tax right there, $1,500. I mean, dude, it's just, you can't argue this. It's just a fact, man. These are just a fact. So what I'd probably do in this case, if I look at the property tax, what I'd do is I'd pull a little bit more out in these areas here, because in this case, our property tax, we're not going to get a property tax deduction because our taxable income would be over $12,000. So let's just look at that. Be 2000. Let's say 2023. Our taxable income, yeah, right here, 69,000 pulling from IRA because he's not on Social Security yet. His wife's got a little bit of Social Security, so his taxable income here is going to be $48,000. So I'd definitely pull more out, so that way I can have to pull less out when RMDs come in because of the property tax exemption in various counties. Dude, I just tell you, man, if you're used to living off $80,000 a year, you can easily do that if you just maneuver this without any taxes whatsoever. If you just know what you're doing. And a lot of people don't. A lot of people say, it's stacked against me. I got to go to the Philippines. Okay. Whatever, man. If you're using the whole reason I started my YouTube videos, a guy down here named Wes Moss. I like Wes Moss. I don't follow him, but I mean, I like him. Yeah, I've seen him do some YouTube. I don't know if he's still on there or not. But he had written an article in the Atlanta Journal-Constitution basically assuming that the retirees are going to pay about 25% effective tax rate on $85,000 a year in income. I said, that's nuts. You're not paying anywhere. That was literally one of the first videos I ever did. I said, that's just not the correct. Married filing jointly on $85,000 of income isn't paying an effective 25% tax rate. I couldn't believe it. That's what started me on the whole YouTube thing right there. So I thank you, Wes Moss, for doing that. This is 6 years ago, man. And I don't have any animosity towards Wes Moss. It was wrong. And hopefully he's correct himself, because if you say we're going to go into retirement plan with an effective tax rate of 25%, and you're making less than $100,000, that's just incorrect. Now, love your thoughts. Don't forget, buy me a cup of coffee, man. And we'll see you in the doopy-doop. See ya.